Okay, let's dive right into this. Welcome to today's Explainer, where we're going to unpack a process that honestly seems like it should be totally straightforward, but is actually riddled with these hidden, kind of archaic rules. Yeah, we're talking about cashing a check. Now, even with the massive rise of digital payments and instant transfers today, checks are still surprisingly common. But actually getting your hands on the cash written on that little rectangular piece of paper, well, it can feel like navigating an obstacle course designed by a ridiculously cautious accountant. So today, we're going to visually map out exactly why banks might refuse to hand over your cash, and more importantly, how you can clear every single hurdle.
To kick things off, we really have to ask a fundamental question. Is a check as good as cash? Now, this is a massive misconception, and it trips up so many people. I mean, we naturally tend to think that if someone hands us a piece of paper with our name and a dollar amount written right there on it, we've practically got that money sitting in our wallet, right? But as we're about to see, according to the rules laid out by financial institutions, no way. A check is absolutely not cash. It's really just a promise.
It's actually fascinating to contrast these two at their core. See, cash has intrinsic value. A $20 bill is worth $20 practically everywhere you go. But a check, fundamentally, it has zero intrinsic value. It absolutely requires verification. When you slide that check across the teller counter, you aren't actually depositing money. You're handing the bank a written request. You're asking them for a favor to, go check an account, verify the numbers, ensure the money actually exists, and make sure the accounts are real before they hand a single cent back to you.
Which brings us to Section 1, Identity and Account Hurdles. So, because checks have no intrinsic value, the bank's absolute first line of defense is figuring out exactly who you are and where this money is supposed to go. Meaning there are two massive hurdles right out of the gate. First up is your relationship with the bank. By law, a bank is completely unobligated to cash a check for you if neither you nor the person who wrote the check has an account at that specific bank. If the check writer does have an account there, well, they might honor it, but only assuming the funds are actually available. Second is the ID requirement. You absolutely must have a valid current government-issued photo ID, like a passport or a driver's license. And really pay attention to that word current. Even if the photo looks exactly like you, if that ID is expired, the bank can and probably will legally refuse to cash your check, just to protect against fraud. And, some banks take that identity verification incredibly seriously. In some states, tellers aren't just glancing at the photo on your ID. They're doing what's called magnetic stripe swiping. They will literally physically swipe the back of your DMV-issued license right through their system. This pulls your data to verify your eligibility to cash the check. They stay strictly within legal limits of what they can do with that info, of course, but man, it's quite a high-tech hurdle for such a low-tech piece of paper. So why does knowing this actually matter to you? Well, because failing to navigate these account rules comes with a real financial penalty. If you don't have an account at a bank, but you go there anyway because it's the payor's bank, meaning the bank of the person who wrote the check, you might successfully get your cash, sure, but you're often going to be hit with a check cashing fee just for the privilege. They're essentially charging you for the friction of dealing with a non-customer. Let's move on to Section 2, the business check trap.
Now, this is an obstacle that catches so many freelancers, side hustlers, and small business owners completely off guard. Let's say we have a guy named John Smith. John is a hard worker, and he just finished up a huge landscaping job. The client is thrilled and hands him a check. But to be professional, the client writes the check out to John Smith Landscaping Services, LLC. So John takes this seemingly harmless piece of paper down to his local bank, walks right up to the teller, and asks for the cash. And the teller flat out refuses. Why? Well, because to the bank, John Smith, the human, and John Smith Landscaping Services, LLC are two totally different legal entities.
To actually unlock that money, John has to take two specific steps. Step 1, he's got to complete his official business registration with the state government, setting up that LLC, corporation, or partnership. Step 2, he must open a dedicated business bank account under that exact registered business name. Only then can he actually cash or deposit that check. And while taking these steps helps immensely with tax filings down the road, it's primarily going to save you some serious aggravation at the teller window today.
All right, on to Section 3, time limits and big sums.
$50,000. That represents a typical daily cash limit that a standard bank branch might keep available for all of its daily customer transactions. See, even if your identity is totally perfect and your business accounts are flawlessly set up, you still have to battle the realities of physical logistics. This limit is exactly why you cannot just walk into a smaller branch or a credit union with a massive check and expect them to hand over stacks of hundreds. They simply do not have the physical cash on site to clear it. I mean, if they gave it all to you, they'd have to tell the very next customer in line that the bank is effectively out of money. So if you have a large sum, you've got to call the branch manager ahead of time. You might need to make an appointment, or they might even direct you to a larger main branch facility. Then we have the issue of time. Checks age, and as they do, they become what the banking industry calls stale dated. Some checks literally have a printed notice right on them saying they void after just 60 days. The Federal Reserve guidelines generally consider checks stale somewhere between 90 to 180 days. But that final marker, 6 months, is absolutely crucial. After 6 months, a bank can legally refuse to cash any check whatsoever. It's just too old. At that point, it's entirely at the bank's discretion if they want to do it as a favor for a loyal customer. Furthermore, if you wait too long, the bank that issued the check might have merged or been acquired, which means the routing number on the bottom of the paper is completely obsolete. But what about the other direction? What if the date is in the future? Well, here's how it breaks down for post-dated checks. If you try to cash a check with a future date, the bank might block it because the person who wrote it gave them advance notice to hold off. And the banks have to follow strict legal timelines for this. If the issuer gives the bank a written notice not to cash it, that hold is valid for a full 6 months. But if they only give an oral notice over the phone, it's valid for just 14 days. Banks strictly adhere to their clients' requests on this. So what happens when this entire process breaks down and a check actually gets rejected?
That brings us to Section 4, the cost of rejection.
It all comes down to a number literally nobody likes to see, $34. That is the average non-sufficient funds, or NSF fee. When a bank returns a check because it's unpaid, whether that's due to a lack of funds, a stale date, or an account issue, somebody is usually paying a fee. Depending on whether you actually wrote the check or you're the one trying to deposit it, incurring these really frustrating penalties is the most likely outcome of a rejected verification. The friction of paper isn't just annoying you guys, it has a very real financial cost attached to it. So we've just navigated this wild labyrinth of identity verification, legal entity registrations, physical cash vault limits, expiration timelines, and annoying NSF fees. And remember, we live in an era where you can literally beam money instantly across the globe with just a few taps on a glass screen. So considering all the hidden rules and potential fees we just mapped out, with instant digital transfers readily available, how much longer will we continue to tolerate the friction of paper checks? It's a fascinating question about the future of our financial habits. Thank you so much for joining me for this explainer, and I hope this helps you navigate your next trip to the teller window just a little bit smoother.